Thanks a lot for that. Those are the stocks which are in focus. But let's also cut across to RBI Governor Shaktikanta, who's currently addressing the Feedback 2019 event.
Policy Committee, the Monetary Policy Committee, before announcing the rate reduction, etc., did very specifically mention that at this particular juncture, growth is a matter of highest priority. And I think this is something which the financial sector representatives, the banks and the leaders from the business community and everyone who is involved in policy making and all regulators are concerned with. Growth today is a matter of highest priority. Now, with regard to injecting the growth impulses, you are aware of the number of steps which RBI has already taken, so I don't want to again list out all the steps that have been taken. And we have also seen in the media that the government has been discussing the various suggestions which have been made by the business and by various other stakeholders of the economy. So having said that growth is a matter of highest importance, it is also important to look at issues of financial stability, because a long-term growth can be sustained only by financial stability or stability of the financial sector. So that is why I have chosen financial stability, as the theme of, my address today. Broadly speaking, the core principles governing financial stability can be thought of in terms of the financial system's ability to facilitate efficient allocation of economic resources, its assessing, pricing, and managing financial risks, and in maintaining its capability to perform these functions even when affected by external shocks. Let me first talk about the global context. The global approach to financial stability changed significantly after the financial crisis of 2008, which made it abundantly clear that the financial strength of every financial institution does not add up to systemic stability. The policymakers realized that macroprudential regulations have to be strengthened and will have to be complemented by by measures which deal with systemic risks and which foster systemic stability. Now, the years after the financial crisis, the Basel norms and the Basel Committee, they became active. In India, we also, the FSDC, the Financial Sector Development Council, the FSDC, and the subcommittee of the FSDC were also set up. The banking system today, as it stands globally, is more resilient to economic shocks. Implementation of too big to fail reforms is advancing, including via establishment of effective resolution regimes for banks. Over-the-counter, that is OTC derivative markets, have been made simpler and more transparent. The use of central clearing has increased and collateralization is more widespread. Those aspects of non-bank financial intermediation that contributed to financial crisis have declined. However, the implementation of reforms is not yet complete and remains uneven, especially in the non-banking space. It goes without saying that while dealing with all these issues, country-specific situations have to be factored in. Recent developments in global economy should be seen in this perspective. A weaker than expected growth with signs of slowdown in major economies is one of the key risks to global financial stability at this juncture. Looming trade tensions, as I mentioned earlier, geopolitical risks, and related uncertainties continue to exert pressure on investment outlook. The latest Global Financial Stability Report by the IMF warns that because of these developments, vulnerabilities in sovereign, corporate, and non-bank financial sectors are elevated by historical standards in several systemically important countries and in other regions. Under these circumstances, central banks and other regulators are required to follow the cardinal principle that the regulator never sleeps. Now, cutting the hyperbole out, what it means is that the regulators and other authorities need to be constantly vigilant and proactively take whatever steps that are necessary. The current state of the global banking sector also presents a story of uncertainty. While bank capitalization has increased significantly in the post-crisis period, primarily, as I mentioned, due to the Basel III norms, bank profitability has been lackluster. Both macroeconomic and bank-specific factors have contributed to this phenomenon. Importantly, banks are also facing increasing competition from non-traditional players such as fintech and big techs, which are taking advantage of digital innovation. These developments have implications for financial stability in emerging market economies like India. It is indeed imperative that banks capitalize on these opportunities. It's absolutely necessary that the banks capitalize on these technological advances and the associated business models. Regulators on their part also need to provide enabling frameworks for these endeavors by banks as well as the non-traditional players. You are aware that recently we have come out with the guidelines relating to the regulatory, the sandbox for, we have come out for fintech, and we are constantly engaged with various sectors from the technological space, from the financial sector space, and from leaders of the business. And from the regulator's perspective, all the required steps, after due consultation with all the stakeholders, which is a continuing process, whatever steps are required to be taken by the regulator to create an ecosystem which facilitates all these activities and enables greater growth in these sectors, the Reserve Bank will not hesitate to take whatever is required to do this in this particular sector. Now, coming to the Indian scenario, the pursuit of financial stability has always been a policy priority in India. I have mentioned about the FSDC and the FSDC subcommittee mechanism. We have a FSDC subcommittee which is chaired by the Governor Reserve Bank, and it has all the regulators, the chairman SEBI, the chairman IRDA, and other regulators are present in that. Now, the headwinds to financial stability could emanate from various sectors of the economy, and there are four specific sectors which I would like to mention. One, the credit markets. Two, the financial markets. Three, the external sector. And four, the payment systems. It may also emanate from other sources as well, but I would confine myself to these four sectors. Now, the headwinds in the credit sector. In India, the credit market, as you know, is mainly dominated by the banking sector, which plays a key role in financial intermediation in the economy. Soundness of the banking system may have a bearing on financial stability through various channels: excessive credit growth, maturity mismatches, and liquidity issues, high proportion of non-performing loans, and over-leveraging, among others. Even if individual institutions are robust, the overall behavior of the financial sector can pose a systemic risk. Hence, monitoring the health of banking sector is crucial for not only financial stability, but for growth. In recent years, as a result of efforts both by the Reserve Bank and the government, the overhang of stressed assets in the banking sector has declined. And going forward, the macro stress tests for credit risk conducted by Reserve Bank indicate that under the baseline scenario, the gross NPA ratio may decline further by March 2020. Other indicators like the provision coverage ratio, the capital adequacy, and return on assets have also improved. I have earlier stressed that I had stressed this earlier on several occasions and in various other forums. The real test of performance, efficiency, and internal stability and governance improvement in banks, especially the public sector banks, would be their ability to access capital markets rather than looking at government as a recapitalizer of the first and the last resort. Despite certain teething problems, the mechanisms which have been put in place by the government, by the parliament by enacting the Insolvency and Bankruptcy Code is proving to be a game changer. New norms for resolution of stressed assets, which the Reserve Bank framed on the 7th of June, and in replacement of the earlier February 12th circular, I think that new resolution mechanism disincentivizes and incentivizes the banks to go for resolution before taking recourse to the IBC mechanism and go to the NCLT. The objective is to ring fence, the whole objective of this circular and the amendments which have been carried out in the in the Insolvency and Bankruptcy Code in the recently concluded budget session of the Parliament. The objective is to ring fence future build-up of NPA stress and protect the banking sector. Now, these measures are very important because as we look to become a 5 trillion economy with the aspiration of creating more jobs, injecting greater momentum to the growth cycle, I think these aspects are very important. As we have seen in the recent past, the buildup of risks among regulated entities due to interconnectedness, exposure concentrations, non-transparent market practices, governance deficiencies, and their contagion effects have repercussions for financial stability. In this regard, the Reserve Bank is keeping a close watch on interconnectedness of the banks and non-banks. The working group on core investment companies has already, which was constituted by the RBI some time ago, has already started its deliberations, and based on its recommendations, the Reserve Bank will carry out necessary changes in the regulatory architecture for CICs. We are also in the process of building a specialized regulatory and supervisory cadre for regulation and supervision of the banks and non-banks. Another important issue in this context is the immediate need to strengthen corporate governance structure in the banks. We have already sent suggestions in this regard to the government, and one can expect the government to come out with certain measures in this regard, and it's heartening to note that the finance minister did make a specific mention about the need for governance reforms in public sector banks in her budget speech. Now, coming to the NBFC sector, about which a lot of reference was made and about which there is a lot of discussion which is now taking place in the public space. We all know that this sector complements the banking sector and aspires to act as the bridge to provide last mile connectivity. Further, niche NBFCs fulfill the unmet and exclusive needs of infrastructure, factoring, leasing, and other such activities. Non-traditional and digital players are now entering this space to deliver financial services by way of innovative methods involving digital platform. There is a web of interlinkages of NBFC sector with the banking sector, capital market, and other financial sector entities. The Reserve Bank keeps a close watch on these interlinkages to ensure financial stability and to create an ecosystem where all these entities, where all these initiatives play a more vigorous and robust role in the economy. With a view to strengthen this sector, maintain stability, and avoid regulatory arbitrage, the RBI and the government have been proactively taking necessary regulatory and supervisory steps. It is our endeavor to have an optimal level of regulation and supervision so that the NBFC sector is financially resilient and robust. We will not hesitate to take, as I like to say, whatever steps are required to maintain financial stability in the short, medium, and long term. Our objective is to harmonize the liquidity norms between banks and NBFCs, taking into account their unique business models. We are also looking at the governance and risk management structures in NBFCs. Recently, in May 2019, the NBFCs with size of more than 5,000 crores have been advised to appoint functionally independent chief risk officers. Now, the intention behind all these measures is to ensure that we have a system, a NBFC ecosystem that is robust and resilient. Now, the move to bring housing finance companies under the regulatory ambit of the Reserve Bank is also very significant given their asset liability profiles. Now, including HFCs, the size of NBFC sector constitutes about 25% of the combined balance sheet of scheduled commercial banks. The Reserve Bank is now the regulatory functions in respect of the housing finance companies have just been transferred to the RBI. We have reiterated that all the regulatory norms which the national, which were in place earlier, that they shall continue to the, all the regulatory norms which were put in place by the National Housing Bank, they will continue. And in the meantime, we are also engaged with stakeholders and we are internally analyzing what kind of regulatory changes or modifications or improvements that would be required. Now, coming to the headwinds from the financial markets, let me say that apart from banks and non-banks, the headwinds to financial stability can also originate from financial markets. The increasing frequency and severity of currency and debt crisis globally and their ability to cause output loss calls for careful regulation and surveillance of financial markets. Globalization of finance, by amplifying the risk of contagion and thereby constraining the policy space for effective regulation, has added to the difficulty of this task. As a regulator of various market segments such as money markets, GSEC, forex and derivatives of interest rate, the Reserve Bank has followed calibrated, sequenced and careful approach to develop and integrated all these markets. The broad objective has been to keep pace with the requirements of fast-growing Indian economy while being vigilant of potential risks to financial stability. This is done through freeing up market forces by moving away from prescriptive to principle-based regulation, whose core features are simplification of processes, encouraging product innovation, removing regulatory differentiation across participant categories, and ensuring protection of retail market participants. Now, there are several examples of the initiatives that we have taken in this regard. I am not going into the details of that. They are all contained in my, the prepared text which I have with me of my address, and it will be uploaded in the RBI website in about an hour or so. So those of you who wish to refer to this could have a look at it. Now, a key feature of regulation of derivative markets has been the differential treatment of professional and non-expert clients. Moreover, differential access to derivative markets is being gradually removed. Anyone, resident or non-resident, can now access these markets for hedging on similar terms. In fact, alignment of incentives for non-residents to gradually move to the domestic market is an important regulatory objective of the Reserve Bank. As you would be aware, the Task Force on Offshore Rupee Markets with Mrs. Usha Thorat, former Deputy Governor, as its chairperson, has made important recommendations that are likely to improve participation of non-residents in the onshore market. A copy of their report is already put in RBI website, and we have called for comments and observations from the stakeholders till 31st August, after which we will take action to implement the various recommendations that are found feasible of implementation. Our aim is to make the onshore market more accessible and attract higher transaction volumes to the Indian onshore rupee market and to the Indian onshore markets. Now, the external headwinds to domestic stability, financial stability, can come from the changing dynamics of external headwinds, etc. I am not going into that. There are also issues related to payment systems which can come into play and affect financial stability. I don't want to sort of take your time to read out all these aspects, but let me just address a few of the issues which have been raised here and which probably engage your attention today. Now, a mention was made about transmission of the monetary policy decisions of the Reserve Bank of India. Now, as I mentioned during the post-monetary policy interaction with the media on the 7th of August, as against a rate cut which was existing prior to the last MPC of 75 basis points, the transmission had been 29 basis points, and it was certainly not up to our expectations. It should be better, and it can be better. But I am happy to note that after the last MPC, where we increased the policy rate by 35 basis points, on the same day and thereafter, various banks have now announced initiatives to link their lending rates in respect of new loans to the repo rate. This is an initiative which the banks have been taking. Several private and public sector banks have subsequently, and in the last few days, have announced their decisions in this regard. Our expectation is that they should move faster. Now, so the Reserve Bank will definitely play its role as a regulator to work with the banks, to see the trends in the market, and take steps that can formalize these linking of new loans to repo rates or to external benchmarks. We have kept the external benchmark, we have kept it in abeyance for, as I mentioned earlier, because we wanted to give an opportunity, we wanted to see how the market evolves, how the market plays out. And it's a positive trend that the banks have responded and are now linking their lending rates, especially in respect of new loans, to the repo rate and other kinds of external benchmark. But this process needs to be faster. And, because today the economy requires a certain amount of push, not just from the monetary policy, but also from its transmission. So therefore, in the presence of the bankers and the leaders of the banking sector, I'm happy to see the heads of so many public and private sector banks present here. I think this is our expectation. And the Reserve Bank is always constantly engaged with all the leaders of the banking fraternity. We will continue to engage with you. But I think the time has now come to formalize this linking of the lending rates on new loans to external benchmarks like the repo rate. We are keeping a close, we are monitoring the developments in this regard, and whatever steps are required in the coming weeks, the Reserve Bank will be sort of initiating necessary steps. A mention was made about liquidity. Now, liquidity, as I have already clarified, it is our endeavor to ensure that there is adequate liquidity in the system to meet the productive requirements of the economy. The liquidity has been in surplus from 1st June onwards. It's now more than 2.5 months that it is in surplus. And every day through the RBI reverse repo window, we are absorbing about 1.5 lakh crores of rupees to 2 lakh crores of rupees. So the liquidity continues to be in surplus, and RBI will ensure that there is adequate liquidity in the system to meet the productive requirements. On the NBFC sector, we are monitoring the various developments that is happening. We are constantly we have a system of monitoring the top NBFCs, about 50 odd NBFCs and housing finance companies are constantly being monitored, and whatever, internally, whatever steps need to be taken to engage with these NBFCs and to see that they do not, that we do not repeat a situation, or we do not repeat a collapse of another major systemically important NBFC. We are constantly engaged in this regard, and it is our endeavor, and this I have said earlier, it is our endeavor, I would like to reiterate here, to ensure that there is no collapse of a large or a systemically important NBFC. Now, the capital requirement of the banks was mentioned. Government has made a provision. Our expectation is that these capital requirement, 70,000 crores for PSBs, which have been provided by the in the budget this year, will be released, at an early date, will be released upfront. This will not only ensure regulatory compliance, but this will also give adequate growth capital, if I can use that word, to the banks to step up their lending activities. Banking reforms is a continuing process, and I did mention earlier that on governance reforms in PSBs, we have sent our suggestions to the government. Digital payments and transactions, we have come out with our vision document of 2021, that is the RBI vision document 2021. We have the Nandan Nilekani report also, and we have now merged both. In fact, there is a lot of synergy between both the documents, and we are committed to implement these measures. We have taken certain other regulatory measures in the last MPC also. As you know, for example, the risk weights that the banks attach to various kinds of individual loans, we have reduced from 125% to 100%. This is moving towards, in fact, this is coming closer to the Basel norms. The Basel norms expect 75% of risk weight to be provided, but in India we had it at 125 we had it at 125%. We have now reduced it to 100%. We have also taken steps to see that the credit flow from banks to the NBFCs for priority sector lending in certain categories, they have improved. Now, there is today a constant discussion between the Reserve Bank and various stakeholders. I have met, I think, the representatives of public and private sector banks about 3 times as a group in the last 7 or 8 months, and individually I have been meeting various CEOs and heads and other senior personnel from the banks. We have had meetings with all the industry associations, the chambers of commerce, and individually and in groups. Many of you have come and met us, met our colleagues. So please continue that practice. We are committed to having stakeholder consultation. We would invite any inputs or suggestions which you have to, in the interest of strengthening or modifying our regulatory requirements to meet, without compromising the regulatory standards, to meet whatever difficulties and to deal with whatever difficulties that you have. So it has to be a consultative process, and we are committed to do that. Now, one word before I conclude, I must say, is that I think there is no need for a kind of, when I morning read the newspapers, or when I open any television business channel, especially on the television, I think there is a kind of the mood doesn't seem to be sufficiently positive and optimistic. Now, one does realize that there are challenges in the economy. One does realize that there are sectoral issues. One does realize that there are severe external global headwinds. And today, India is a part of the global economy. Obviously, India cannot be an exception and cannot live in isolation. But let me say, I think I mentioned it in the beginning of my address. Either we take a mood, I use the word that the mood ranges from an existential angst to a more positive outlook. I think there is no need, I feel, and I would appeal to leaders of business, to leaders of the financial sector fraternity. I think it's the sentiment which is very important. Please look at the opportunities that lie ahead of us. We do realize that there are challenges, there are difficulties coming from external sources, domestic sources. Domestically also we have certain challenges. But I think one has to look at the opportunities, one has to maintain a positive sentiment, look at the opportunities and capitalize on these opportunities, because a mood of doom and gloom is not going to help anyone. It's neither going to help the banks, it's not going to help the business, it's not going to help the real economy. But at the same time, I'm not saying that we take, I'm reminded of this great thinker Pangloss, I'm not saying that we maintain a kind of a Panglossian countenance, that we smile away every difficulty. I'm not saying that. But I think it is very important in any business, in any real economy, it's the sentiment, it's the mood which is very important. And on a more serious note, let me say that there are several opportunities amidst the challenges that we face today, and together the financial sector, the business community, the policymakers in government and the regulators like Reserve Bank, I think we should look at the opportunities, address the challenges and look ahead with greater confidence. Thank you.